from institutional international capital, there are a lot of different strategies to be implemented. So clearly France is one of the top markets in Europe because of its size, because of its liquidity and transparency. Yet there is tax uncertainty, which raises concerns, particularly for Asian funds. They're worried about what taxes and what would be the impact on the property value if they hold it for 5 years. This is quite logical because of there's always uncertainty surrounding France, but France still remains one of the core markets in Europe. So in the first place, London will certainly benefit of these inflows. But I think that for a pan-European diversified portfolio, you definitely need to have Paris. And there are ways that we in Invesco Asset Management can provide with targeting central locations, trying to compensate for that risk for low growth environments. So it's taking the most defensive. And just to answer the first question about the low growth environment, what would be the potential implications for it? I think that what international capital is doing is clearly looking at the fundamentals, looking at what's healthy, what's robust. And clearly Germany is the top market to be in Eurozone. But they don't want to overpay. They don't want, depends also on the capital, but they don't want to pay the maximum pricing to reach that potential. So that's why also they're more in a wait and see and trying to find the best asset for the pricing they are accepted and willing to pay.
Good. Yes, go ahead. No, only one short sentence about that. I think we have simply also to realize and to accept that their investment horizon is completely different from what we are used to see. They're thinking in generations and not in 5 or 10 year terms. So especially if you have an institution where government money is directly or indirectly behind, they're not going only for a yield of 5% for the next 5 years. They would like to stay for the next 10 to 15 to 20 years. And so I think we must simply appreciate that they have not the same mindset when investing in real estate in Europe than we would have as institutional investors thinking in cycles.
It's definitely the case that there are some deals made by Asian money, and that is a long-term investment. But we shouldn't forget that they have already started in the US some years ago. So Europe is now the second wave of exporting capital into real estate markets, and it is definitely, in our opinion, the aim to protect capital, not to achieve high returns or high deals. It's really capital protection, and that's why they're looking for prime properties only, and really only, and that's why also they do not overpay, as you said.
Well, some of it came to France already. When you see, for example, NPS, which is the Korean pension fund, which has been buying in France already. They did 2 transactions. They have several asset managers. I think this is probably the key for them to enter the European markets, which are very, very... They are not at all familiar with our law system. They're not at all familiar with our real estate market. It's quite intransparent on the continent, at least. And so it's really very important for them to have a good asset manager following them. What they have been buying so far here in France is completely what you just said, and also you, which means that what they did is they bought the big tower, which is called Sequana, which is a huge investment, over 300 million euros, where they had the opportunity to buy a property which is not a core prime property, but still a very core property, and where they paid a very interesting price. So I think it's really a combination for them of core product, but still in a way not prime, which means they won't be able to pay 4%, 4.5%, at least not the funds. Probably the family offices they would one day, but that needs still a long-term education, I think. I think we see the money coming in, but we are probably still in the educational process here in France.
I mean, they want to limit leverage to 50%, maybe maximum 60%, but they definitely look for leverage. And I think also because having bank finance available is a proof of the bankability of the investment. Some of these funds are among our clients and among large clients of ours.